Hello, and welcome to the video version of PKF Francis Clark's Autumn 2025 FD seminars. This is the corporate reporting session, so we're going to focus mostly on accounting requirements, accounts front-end requirements, and changes coming in from Companies House. So this is a bit of a corporate reporting plus Companies House update. My name is Alex Davies. I'm a director in the technical team at Francis Clark. What that means is that essentially I'm part of the team who roll out internal training to all our people and help with difficult accounting and auditing questions and company law questions. So if you're working with any of the teams at Francis Clark, they've got me and my team in their back pocket for technical support on those accounting, auditing, company law questions, anything other than tax effectively. And they will have that support and resource available if they'd like a second review of anything you ask them. So you probably won't meet me, but your team may well be talking to me to make sure they give you the right advice. Our agenda for today is to begin with ID verification, which is going to be relevant to a lot of people listening in. A quick summary of other companies' house changes and other things going on with IFRS. There isn't a huge amount that we didn't talk about a year ago, but I'd like to repeat it for the people it's relevant to. A reminder of things to do at the moment for FRS 102 changes. We've done a lot of education on the FRS 102 changes in previous webinars, and if you would like to see a focus on the revenue changes or the lease changes, we recorded those too. So by all means, just get in touch with the person who gave you this link. We can give you the links to the revenue and lease recordings, but this one is focused on getting ready for the beginning of your first period under the new rules, which for a lot of people listening will be 60 days from now. And finally, we're going to do a bit of a case study on accounting for acquisitions, hopefully a little bit of educational content and thought-provoking content on how you would do that. So that's a slate we have coming up. But agenda item number one is ID verification. And I'm going to start with the why. This is a real BBC News headline from a couple of years ago. Heston Blumenthal was targeted in a company cloning scam. What that means is that somebody went onto Companies House and they made a fictional business called Dinner by Heston Blumenthal. They set it up with the name of one of Heston Blumenthal's known restaurants, and then they went to take out a business loan. The bank didn't say, who are you applying for a business loan? They just said, oh, yep, please give me the company number. And they checked the company number, and there it was on Companies House called Dinner by Heston Blumenthal. You know, there it was, Heston Blumenthal, supposedly a director. They said, all this sounds legitimate. They didn't phone Heston Blumenthal or his restaurant or do anything to verify this. They just gave them a loan. And then the fraudsters walked off with the money, and Heston Blumenthal's restaurant got a letter saying, hey, you've got a loan now. This has happened to a lot of businesses. It's happened to some of our clients as well. Any well-known local business could potentially have been targeted by this, just by somebody making up a business. And the ones at the bottom of this slide are real fake businesses that were set up. You may be able to notice minor spelling mistakes in the name of Cambridge or Blumenthal, but they are nonetheless real fake businesses that were set up by real fraudsters to try and take out fake loans in other people's names. And this is considered a problem. On top of that, the Ukraine invasion by Russia made us reflect on just how enmeshed parts of the UK financial system are with international money laundering. And we also think this is a problem. As a result, we got the Economic Crime and Corporate Transparency Act 2023, which has put in all sorts of things to try and tighten the screws on fraudsters and money launderers. And one small part of this is ID verification for Companies House. From now on, if you want to set up a company on Companies House, or for any and every existing company, LLP, organization on Companies House, their directors and their persons with significant control need to verify their identity to try and cut down on the options for fraudsters. And this is going to be relevant to the vast majority of people listening to this webinar, because either you yourself listening to our finance director seminar are a finance director, or quite possibly your boss is a finance director, right? So either you or your boss is going to be either a director or a person with significant control over a company, and they will need to verify their ID. So how does that work? Well, there's a couple of options, but the main and the recommended option is just to use the government website. The link that's here on screen, verify your identity for Companies House. It is effectively a government website linked to gov.uk one login. What you do is you pick the email address that you will use to attach your verified identity to, which should also, if you need to log into Companies House for anything, that should be the email address you use for Companies House, and it should be an individual email address. You'll get that set up on one login, set up multi-factor authentication, text messages, or an authenticator app, and then you will probably download an app to your smartphone. With that app, you're going to photograph your passport page, scan your passport's biometric chip, which you do, the same way as you scan a contactless credit card with your phone, and photograph yourself. And all of that will give you a personal code available on the gov.uk One Login website and Companies House, which is unique to you. And if anybody wants to set up a company in your name or say that you're a director of a company, they will need to provide Companies House with your personal code. Companies House will assume that anyone who has your personal code has your approval for any companies that they attach you to. Now, just as an aside, this is not actually a very good or secure system. You set your personal code up once, and for all that we know, this code will remain the same for the next 6 decades. Anybody you give your code to at the moment can, 50 years from now, use it to evidence that you're linked to some other company. So this is not great, and you should look after these codes carefully. For your own business, you're going to need to gather these codes up to do your confirmation statement. I recommend they are not just stored on an unprotected document on your network somewhere, right? You should get them, gather them securely, share them only with the people preparing your confirmation statement because they're going to need them, and consider how you do that sharing as well. For us, the only place we're going to store them is in our company secretarial software, which is accessible only by certain people. Obviously, the company secretarial specialists within our offices can access several clients' records within that office, but we've locked it down to the amount that is sensible and safe and been really careful with who can access this information. There are other methods to verify your identity as well. So if the app doesn't work for you, or let's say you can't access the UK App Store, you can also enter your details into the same website, say your passport number and things, and then it will give you a piece of paper to take to a local post office where you can show them your passport, and they will confirm that you look like your passport photo and the ID number really does come from a real passport. You can also answer a barrage of security questions, and if you get all of them right, it will verify your identity. So there are other options in there. Additionally, for people, if your name on your passport is different to your name on Companies House, for example, or if you are an overseas person, we've got a web link later, which basically First Corporate, a legal services provider, can likely help you out. So I'll share that in a bit. You do have other options for how to get your personal code. So when does this need to happen? It is not a nice set of rules. If you're a director, then for each company you're a director for, you need to give your personal code to the person preparing your confirmation statement before they submit it. So in practice, that means for your company, whoever's preparing the confirmation statement needs to be given a code from each director before the first of your group companies needs to file a confirmation statement. If you're a director and a PSC, person with significant control of the same company, you need to do that, and also input your personal code into a separate web page yet to be launched within 14 days after the confirmation statement has been submitted. If you are, bottom left now, a PSC but not a director, then you will need to put your personal code into this yet to be launched web page within the first 14 days of your birth month, starting with people born in December. I didn't write the rules, I'm just telling you. There is a web page which sets them all out. But yeah, PSC and a director before the confirmation statement submitted, and again within 14 days afterwards. PSC and not a director, first 14 days of your birth month. New directors before being appointed, new PSCs the same. Individuals filing documents at Companies House, so this might apply to the finance director or company secretary within your business. It's before you need to file your first document after the 18th of November. So bear in mind that might sweep you up anyway, even if you're not a director or a PSC. The process is a bit of a pain. It can take up to half an hour, well, it can take longer, frankly. So I would clear 45 minutes just to be on the safe side. With a fair wind, you might be through the whole thing in 15 minutes, but it is pages of web page bureaucracy and app downloads and photos. So, just clear some time just in case. And if you do get it done briskly, be grateful. What do you need to do about it then? Check those dates, right? We will be sharing these slides. If you're watching this on a video, you can skip back a minute. So check which dates apply to you and when you need to do this by, when your other directors need to do it by. If you've got a UK driving license or any country's biometric passport, go for the website route first. We've put a walkthrough on our website with pictures. Follow this link, you will see it. That will help you get through it. If you're overseas, if your name doesn't match, if the UK website locks you out for whatever reason, we recommend you go with First Corporate Legal Services, the link there. To be clear, any authorized corporate service provider in the UK can do this for you. Many accountants and lawyers have registered as an authorized corporate service provider. We have not at this stage because, frankly, we would prefer to be in the space of giving advice and things, not just doing compliance. First Corporate are good at doing compliance. They can do it more cheaply than us. Head over there. They will likely be able to sort you out. The kinds of reasons that you might get locked out of the government website, well, if they ask you what year you moved into your house as a basic security question, and you get that wrong, as some people have done, they will say, clearly you're not you, go away and give up. And that's where you need an alternative route. So when you get asked those questions, please take them seriously. And the other thing you could go for is filing a confirmation statement before the 18th of November. That won't remove the requirements, but it will give you most of an extra year to prepare for them, at least for the confirmation statement related ones. So that's going to be a pain for everybody, directors, persons of significant control, probably average half an hour of extra work for each director in the country, but it's all doable. We've got to walk through. The government's got a free website. It can be done, just get it done on time. It's just a logistics thing, then it's out of our hair. And it should mean that, real businesses have fewer fraudulent companies set up mirroring their names and fewer loans taken out in their names. So there is a definite benefit to all of us in reducing fraud in the ecosystem. Cool, that's ID verification. Now, other companies' house and reporting changes. Um, Many of you will have heard this was literally in the last 2 weeks. Rachel Reeves has said the director's report will be removed. The size threshold for the strategic report will go up, and wholly owned subs will be exempt from a strategic report as long as they're covered in the groups ones. The key point I want to make with this is that this is an intention. The government has said it would legislate as soon as possible, which I would hope would mean within this calendar year, but it definitely hasn't happened yet, right? And therefore, we also don't know when these things will apply from. For now, if you're submitting any accounts in the next 6 months, I would assume you still need to operate under the current rules until you hear differently. Um, yeah, watch this space. We will tell you when we hear something. When the legislation is published, it might apply to all sets of accounts filed from that moment onwards. That would be the most generous interpretation. But it might also, apply to some future year-end period starting on or after, etc. And in that case, there'll be a transition period. So don't just assume you don't need to write a front end anymore. Watch out for the news. Changes that already happened, periods starting on or after 6th of April 2025 operate under increased company size thresholds anyway. The government was already getting going with a bit of a growth agenda. As you see on the screen, broadly speaking, most of the thresholds have gone up about 50%. They're also now more rounded numbers, which is nice. If you've got one of these periods starting on or after 6th of April 2025, and these new rules do apply to you, when you're assessing your size, you should assume the new thresholds had always been in operation. So, if you want to change from being small to medium or medium to small, you need to come under 2 of the thresholds for 2 years in a row. You would assume in looking at last year's thresholds that these new higher limits had always applied. Also already here, the failure to prevent fraud legislation. And this is a similar idea to the Bribery Act, which has been around for about a decade, and the corporate criminal offence for failure to prevent tax evasion, which has been around for a few years now. Basically, if you are a large company or LLP, more on those limits in a minute, and your employees do something because they think it'll be good for your business that breaks the law, then your company can now be sued for it. Essentially, there were points in the past where a company would be found to have fraudulently misstated their accounts or had bad sales practices, or think about all of the car finance mis-selling stuff recently, and they might have said, oh, it was a rogue financial controller, it was a rogue sales director, it was just this junior person doing stuff because they thought it would be helpful. And the police look at it and they say there's no point in sending this junior person to prison, but we've got no grounds to sue the company, so nothing happens. Well, now the answer, and if you are a company's finance director, this might be a slightly scary answer, they can sue your company for things that its employees have done. And the presumption is that your company or LLP has committed an offence as if you did the thing. unless you have reasonable fraud prevention procedures in place. These reasonable procedures are the stuff you see on the screen here now. And this is where it's similar to the Bribery Act and the failure to prevent tax evasion. Essentially, you need top-down messaging, which means internal comms, by the way, on, we actually want to do things the right way. You might think you're helping, but you're not. Please don't break the law on our behalf. And that message needs to go out to everyone in your company. You also need the risk assessment of how that might happen and proportionate ways of making sure that people do abide by the laws and not take shortcuts, right? So more information as this is on the government website. If you search, failure to prevent fraud guidance, you will come up with pages and pages of government stuff on this. But it's also not a brand new concept. If you use any training providers for existing legislation, they will probably have courses on this at least by next spring. And also, if you speak to Chris Rogers within our tax team, he does have some information that can be used, or ask your Francis Clark contact to get in touch with him. We've got some information that can be used to help. We can assist with some of this stuff. And naturally, we're doing it ourselves. And for any Francis Clark people listening in, please don't break the law. We mean it. We want to do things the right way, right? But the challenge for you is going to be, if somebody in your team does just take shortcuts, say stuff in adverts that aren't true, missell things, not tell somebody that a customer has overpaid them, that could come back on you. Under these 6 bullet points above, would you have a defense? Other changes are coming. So we've spoken about everything in the this year category. Oh, you can also hide your personal addresses. Next year, we are expecting the changes that Rachel Reeves recently announced. You will see a couple of things here with question marks on. We have been told, it has been announced, that from April 2027, all small companies will still need to file a profit and loss account. So at the moment, if you're a small company, you file your accounts, you remove your profit and loss account almost every time. And therefore, people can't see how much money you're literally making. That is scheduled to go away from April 2027. Also from April 2027, all sets of accounts filed will have to come through some kind of approved software. So if an accounting firm makes your accounts at the moment with whatever software, there's almost certainly going to be a method they can use to automatically upload that to Companies House for you. But if you make your own accounts in Word, it's going to have to go either to an XBRL tagging software, which you're already going to use, that then has an upload facility built into it, or after being tagged, it's going to have to go to some new third party to do the upload for you. Naturally, for our clients, we're working on methods, and actually those are fairly well advanced. But if you do your own accounts at the moment and you're going solo and you're filing them solo, you're probably going to need to work with somebody else in the future to get this done. Right? The question marks, though, are because days after the announcement came in, multiple government sources briefed all sorts of newspapers that, well, this sounds like a lot of extra work and we're against extra regulation, so maybe we'll put a pin in it. Right? We will see. Watch this space. They've said nothing else since. The announcement is still in effect. This is still currently expected to happen from April 2027. In theory, the idea that you file all your accounts from the software that created them could be a time saver. Saves all the hassle with the post on the last day of the month. And in theory, filing the P&L that you've already created does not create an extra admin burden on businesses. What it creates is less privacy for people who own their own small businesses, right? So it's not really a regulation burden thing. It's a, where do you draw the line between transparency for big businesses and privacy for small ones? So those will continue to be argued about, but for now, I would assume they are coming in as announced. But watch this space. And the other things there we've spoken about before. If you're interested, Google them. But there will be limits on shortening periods, which will make it harder to get an automatic cheeky filing extension by shortening your accounting period one day. So, you should be planning to have your accounts done within 9 months of the year end. Again, that's a 2027 thing, but well, it's not even published actually, so we don't know for sure, but I'd imagine it's 2027. But you may want to use the next couple of years' sets of accounts as a trial run just to get back into the pre-COVID habit of actually filing your accounts within 9 months of your year end. Right, that was the Companies House changes. Quite a bit coming, as you can see. The big one for now is the ID verification. The big one for the near future is the failure to prevent fraud. And let's watch this space for the actual legislation and transitional arrangements for the changes to the directives and strategic reports. Next up, a brief IFRS update. For those who attended or watched this last year, it's mostly the same news, to be honest. So this won't, we won't belabor the point. So Period starting on or after 1st of January 2025, that is current upcoming December 2025 year ends. The only change to UK adopted IAS applies to foreign exchange for currencies that aren't traded. I mean, if a currency is not traded, you are probably not buying and selling it. So this probably does not apply to you. But if you think it does, go read it. Essentially, for the majority of businesses, that will have no impact. Next year, period starting on or after 1st of January 2026, there are two main changes coming. If you deal with renewable energy, basically weather-dependent electricity, then there are new arrangements in exactly how you'd consider the application of hedging rules. So if you make renewable energy and you're thinking about applying hedge accounting in IFRS, go read those rules or talk to us. Also, there are amendments that hit everybody to the complicated rules on financial instruments. This mostly hits IFRS people. A few people applying UK GAAP voluntarily apply IFRS 7 and 9, but it's very rare. So IFRS people, minor amendments to the rules on financial instruments. In particular, at the moment, you can only de-recognize a liability once it's been extinguished, if that all sounds overly formal. Imagine the case where you try to pay a bill and you pay it by bank transfer. You process the bank transfer on Friday. The bill isn't actually paid. It doesn't hit the other person's account until the next Monday. Well, officially, until you have successfully extinguished that liability, i.e., your customer's got the money or your supplier's got the money, you could probably argue the strict interpretation is your liability still exists until they have the money and it has been cleared, and therefore you should still have the liability in your books until they receive it. Of course, you don't necessarily know when they receive it. So they're bringing in an option that actually, if you have initiated an irreversible payment, you can count that as settled and take it off your books. Frankly, that's the common sense approach anyway. A lot of UK GAAP companies have just been doing that for ages anyway, but it will be officially okay for IFRS entities once these new ones come in for next year. I would suggest most people would not be too exercised if you were already doing that, but there are cases where it can make a material difference, and technically that's not yet the rules, but yeah, apply common sense sometimes. And the other one that I wanted to pull out from that raft of little tweaks to those ones is guidance on when loans are purely repayments of principal and interest, and essentially this talks about how complicated you need to treat them as being. If this doesn't mean anything to you, then you probably don't need to worry about it too much. But the case where it can particularly come up is if you have something like waterfall payments. This is where sort of there's some underlying financial instrument or investment or entity which is performing in some way. And then you get a combined set of loans where the initial returns on that go out to one party. And then once it goes over, say, £1 million, someone else starts to join in the fun. And there's renewed guidance on when that counts as purely repayments of principal and interest and when that counts as complicated. So if you're entering into waterfall financing in an IFRS set of accounts, I would take a closer look at those rules or come chat to us in the due course of time. Bear in mind, this is a next year problem, not a this year problem, but hopefully that helps you understand whether that's you or not. If all of that sounded over your head, it probably isn't you. The bigger ones that are coming are still coming well in the future, right? So heads up, but not yet. IFRS 18 will change how the P&L looks, the income statement looks for IFRS sets of accounts. And in particular, they're going to have an operating profit line from now on. So they'll have to be careful whether things go above or below it. Most UK GAAP sets have done this for ages, and therefore many UK IFRS sets have voluntarily done it for ages. There'll be more stuff on adjusted EBITDA and things, but again, mostly we're having to do these things anyway. So it shouldn't make the most massive difference, but it will make IFRS sets of accounts look more consistent. If you're one of the few UK businesses who's preparing IFRS looking accounts under IFRS 102, yours will also change to match these. And the other one, IFRS 19, this is a really good idea, so good that we already basically have an equivalent in the UK. The idea is if you've got a big group of companies and the parent provides all sorts of IFRS disclosures on what's going on, well, the subsidiaries get let off some of those disclosures on the basis they're already present in the parent's accounts. Now, in the UK, we achieve this using IFRS 101. It is basically IFRS for subsidiaries with extra disclosure amendments, disclosure exceptions, right? The thing is that if you're trying to sell your business overseas or work with overseas investors in any way, if you tell them your subsidiaries all apply IFRS 101, they might say, well, we don't know what that is, but we don't like it. So now you'll have the option of applying IFRS 19 instead, and it'll just look a bit more cozy and familiar to overseas investors. Also, if you're a UK parent, you've got overseas subsidiaries, Well, they obviously can't use IFRS 101 because they're abroad. Now they'll have IFRS 19. So in some circumstances, it will give you slightly less work to do. Right? Otherwise, it's not the biggest news. And like I said, the UK has an equivalent already, but we expect both to be available based on the comments made by the FRC and the UK Endorsement Board. And that is our IFRS update. Right, again, if any of that sounds interesting, this was not a training session. This was just a sort of heads up. If you want more information on these, come talk to us. We have plenty of time to prepare. Right, something that's going to hit far more people are the IFRS 102 changes. We have banged on about these for a little while. There are going to be changes coming to the revenue rules, the lease rules, and small company disclosures under Section 1A. Right, all this is coming for periods starting on or after the 1st of January 2026. So for December year-end businesses, this is next year. This is a few dozen days away, right? This is coming soon. We've already talked in detail about the revenue rule changes and the lease rule changes. But like I said, the links to those videos are available for the same people who gave you the links to this video. So go ask for them if you'd like to see them separately. But we're going to focus today on being ready. Revenue-wise, what you want to do ideally is get a list of every type of contract you have, classify your contracts carefully. For each contract, look at all your performance obligations and decide which ones are distinct. And for each performance obligation, which is a thing you give your customer, decide whether that's going to be recognizing the revenue once it's finished or while it's happening. Right. And that's at the core of the 5-step model of revenue. You decide what things you're giving your customers, which of those are distinct, and then for each one, do you recognize revenue while it happens or after it's done? If you don't have much time left, at least rather than analyzing every single contract you have, you could just brainstorm what are the things we do for our customers and figure out whether those are going to happen after it's done or while it happens. Once you know that, you can ask yourself, is that different from my current revenue recognition? If it's all the same, then you will need to get to grips with the detail in due course, but it shouldn't change much. If the treatment of how you're going to deal with some of these performance obligations is likely to change, that tells you you need a deeper dive and a deeper analysis of which contracts that would impact, right? So your shortcut is to begin with, just list all the performance obligations you provide, figure out whether the treatment of any of those is changing. That will tell you how seriously to take this and how much to panic. If your answer is panic, come talk to us, we can help. Leases, a list of your leases. Guiding star for this, because the leases is a big change, right? Basically, you're going to bring almost all your leases onto the balance sheet, barring exemptions. When you bring your lease onto the balance sheet, you're effectively saying, instead of renting this asset, I am borrowing money to buy the use of the asset for a little while. So therefore, you put the right to use the asset for 10 years on your balance sheet, and you put the loan on your balance sheet. Now, that basically increases both your assets and your liabilities by pretty much the same amount, give or take. But what it also does is it replaces your lease payments that would have gone through operating expenses, probably, with depreciation on the right of use asset and interest on the loan. Now, depreciation and interest aren't included in EBITDA. So every time you get a choice in this standard, when you're choosing whether to put low value leases or short-term leases, through the new rules or whether to take the exemption, you are choosing, do I want to keep these off the balance sheet and have figures that are consistent with last year and a bit simpler to deal with? Or do I want to put them onto the balance sheet and take depreciation and interest out of EBITDA, improve my EBITDA as a result? Right? That's a strategic decision for your business, and you want to act strategically rather than just doing whatever's easier or the first idea that comes into your mind. Once you've decided whether you basically want more of this on the balance sheet, improving your EBITDA, or you want wherever possible to do the same as last year, then you can decide on your exemptions and decide when you're dealing with, let's say, car leases and building leases, whether you're just going to put the pure lease component onto the balance sheet or whether you're just going to include every payment under that contract. So including your sort of car park maintenance and your car servicing elements, the non-lease components, whether you want to include those in the new rules as well, which will turbocharge the impact of improving your EBITDA. The other thing, as an auditor, I would really like you all to do, just about exactly on day one of your new period, is get hold of your obtainable borrowing rate. Basically, if you bring a lease onto the balance sheet, then unless you actually know the fair value of borrowing a building for 10 years, which is not an easy thing to know, you're going to need to estimate it by discounting the future payments back to today's date using your obtainable borrowing rate. And the obtainable borrowing rate would normally be as at day one of the lease, but for transition, it's going to be as at day one of your first period following these rules. for a lot of you, 1st of January. So second half of December, first half of January, you ought to be going to your bank or going to other finance providers and just figuring out, if I wanted to borrow this kind of amount of money, what kind of interest rate would it cost me? Now, the obtainable borrowing rate has been brought in as a new option by the FRC and is purposely designed to be simpler, easier to get, and less onerous than the previous options under IFRS. And therefore, you do have a good degree of flexibility about this. Basically, it should be for the same kind of amount and the same kind of time, and that's it. As long as you've made a sincere effort to find a somewhat comparable rate for a similar amount of time, we'll accept it, right? I've seen some pretty outlandish things suggested. There is flexibility here as long as the amounts and the time are vaguely okay. But try and get that as close as possible to day one of your period and keep evidence, which might be a screenshot of an online page, quoting the price for new borrowing. It might be email correspondence from your bank manager. Your bank managers will get very bored of people asking them questions. Hey, if I wanted to borrow about 100K of stuff for 3 years, what would you charge me, right? But this isn't about haggling. It's about getting a rate you can plug into your figures, right? So just ask them briefly, accept their answer, keep the email, and then you've got evidence for your auditors for the calculation later. And the other thing is, think about what this will do to your covenants. More on that in a moment. So you might have changes to your revenue. You might have changes to your leases. That would do something to your numbers. For next year's accounts, you are not required to restate your figures at all. In some places, you have a choice, right? Oh, sorry. There are minor changes that I haven't mentioned to other parts of IFRS 102, which are probably not going to impact you. For those, you should restate your prior year figures. But for the big ticket ones for revenue and leases, right, you don't have to restate your prior year figures. However, for internal projections and management and strategic decisions, you quite possibly do want to figure out, how would our 2025 numbers have looked like in the context of the new rules. Having done that, you can say, would we have broken our bank covenants, right? And if you would have, you should go talk to the bank. Also, what would it have done for our bonuses, LTIPs, share options, earnouts, right? What impact will these changes have on knock-on effects for other parts of your business, right? If your EBITDA massively improves, this might mean that you need to pay out on options you didn't expect to pay out on. It might mean you have to pay out on an acquisition earnout you didn't expect to pay out on. If you're negotiating an acquisition at the minute, what set of accounting rules is that going to be based on? Is it useful for you to specify that it continues to be the old rules or will be the new rules, or indeed just not to mention it and implicitly have it become the new rules, because that's going to help you get a bigger earnout, right? The people who plan ahead are likely to do better out of this. If it is going to impact your bonuses, LTIPs, share options and things, there are quite probably going to be mechanisms in there that allow people to take common sense decisions and how the targets apply. Go check these. I would watch out there, just a note of caution. If you change things on bonuses, LTIPs, share options, these things generally, they get taxed when they pay out. So fine, that's a tomorrow problem. If you've got any growth shares or anything, and you go ahead and actually change the terms of those existing shares, because people already hold those shares, that can create a taxable charge in the moment. So definitely, if you're going to make any changes in application for actually existing shares that pay out on things, take advice first. And I would generally suggest take advice generally. But yeah, once you've done all that thinking, what are our numbers going to look like? What would it do to our covenants? What would it do to bonuses and other stuff? Well, then discuss it with the people you need to, right? That's the strategic FD type stuff coming out of all this. If you've had those thinking aheads and conversations, if you've also checked, is this going to make a major difference to our revenue recognition, and you've also got hold of an obtainable borrowing rate for your leases, you're probably in decent enough shape, basically, coming into the year. But bear in mind, this is coming very soon, right? A few dozen days until 2026, then the new rules do apply. Ultimately, you'll be making accounts under these new rules in early 2027. You will be surprised how quickly that sneaks up on you. Right, final piece of all of this. I'd like to actually do a sort of, educational dive into a topic that is not IFRS 102 rules for once. And that's going to be accounting for acquisitions, right? Basically, we see a lot of acquisitions at the minute, and a lot of that is for two reasons. One is there's still a whole load of private equity money around looking for people to invest in, right, and therefore deals to be done. And the other is that changes to tax and worries about potential changes to tax are making a lot of individuals make changes to what they own, basically. So acquisitions are happening. When you make an acquisition, you might have two choices in how you account for it. You've got acquisition accounting or merger accounting. Broadly speaking, acquisition accounting is what you do if you've gone to college and they've told you how to account for acquisitions, right? It's the bit where you fair value everything, including things that aren't even on your balance sheet, which might create new intangible assets. And then you recognize goodwill for the difference so that the fair value of all of the assets and liabilities on your new acquisition balance sheet are equal to the amount you actually paid to buy the company. Right. And that's potentially a whole load of work in that you're doing fair value calculations for loads of things, other implications too. The other alternative, maybe, is merger accounting. And that's where you basically use all the previous numbers, which is much simpler to do, but then gives you a smaller balance sheet in most cases, swings and roundabouts. The key with merger accounting is that it is only available if the ultimate owners of the business and their relative rights are basically unchanged before and after. Some tiny, changes can be accepted, but you should not have a brand new investor involved. You should not have somebody's shareholding falling from 50% to 40%, right? It should be basically the same owners with basically the same rights before and after if you want to use merger accounting. So that means if you've got an MBO or something, then actually the whole point of the management buyout is that now some of management own part of the business that changed the ultimate owners, right? So you have to use acquisition accounting. But be aware that you do, in theory, maybe have two choices, and so you should choose intentionally. If you've gone the acquisition accounting route, I said one of the implications is you might need to bring assets onto your balance sheet at fair value that weren't even there before, right? And this works differently in FRS 102 and IFRS. I'm going to start with the IFRS rules because they are fixed. Basically, under IFRS, if something arises from contractual or legal rights, you put it on your balance sheet. So, for example, if you have great contracts with your customers, which give you sort of, the potential for a profit stream for the next 5 years, well, those arise from 5-year contractual rights. If you have a 5-year contract they can't get out of, and therefore you would put the value of those customer contracts on your balance sheet because it ticks the contractual box. Also, if you own stuff that you could sell off as a business, like a patent or a trademark or something, that ticks, well, actually both the boxes because legal rights and can be sold separately. Um, so those things you would have to put on your balance sheet as intangible assets. Under FRS 102, you technically have a choice. You can apply the IFRS rules as I just described, or you can change the word or in there to say and instead. And you only put a much narrower subset of things onto your balance sheet if they both arise from contractual or legal rights and could be sold separately. And then your customer contracts, for example, you might have lovely customer contracts which give you, locked in customers for the next 5 years. That's contractual. But unless you have the right to transfer or sell those contracts, they don't tick the second box. So basically, under UK GAAP, most people choose to put an and in there. And therefore, most people don't identify many intangible assets at all, unless it's brand, trademark, patents, that kind of stuff, or unless it's something contractual that can also be sold, which is where we get to the brand, trademark, and patent bit. Right? If you do put an intangible asset on, the thing is it's a bit of a pain, basically. So once you put it in your books, you've got to fair value it. And that costs money, so you'd probably rather not. And anyway, the difference is going to be goodwill, which is another intangible asset anyway. So you're not even really changing in numbers much. You're just having to pay money to fair value it. And that's why most businesses decide to take advantage of the option of changing the or into an and not really putting many intangible assets in. The other thing you need to do is fair value the existing assets and liabilities already on your balance sheet. And this could cost you a lot of money. If you go to an expert and say, hey, please fair value every number on my balance sheet, you will be paying them lots of money to do that. So it is really useful to think through to yourself, where's it going to make a difference and where won't it? Trade debtors, to take an example on there. Well, what's the value to me of having a trade debtor? It is probably just the face amount of that trade debtor, which is what it's already in my books at. It's never going to be worth more than the face value. They're not going to pay me more than they owe me. It might be worth less, right? Maybe if I'm worried about their ability to pay me, or I'm worried that they won't pay me for 2 years, then maybe the fair value is less than the face value. But in that case, you should already have provided against that debtor in your books. So broadly speaking, as long as you've done your trade debtor provisions properly, your trade debtor should basically be at fair value. So don't mess around paying anyone to figure it out. Where should you put your attention? Well, basically, buildings held at cost, right? Buildings held at cost that you bought ages ago probably have a fair value way above what you paid for them. Some other appreciating assets, the kind of assets that get worth more money over time, if you measured them at cost, they're probably going to need some kind of fair value uplift. Machines, fixtures, fittings, vehicles, you might have measured them at cost, but they're probably worth less now than what you originally paid for. And as you've been depreciating them over time, that's probably close enough. So you may sometimes feel you need to make an assessment of, might the fair value be materially different to the carrying amount? But in many cases, you'll decide you're fine there, right? Just watch out for buildings and other appreciating assets held at cost. And the other one to sometimes watch out for is stock and WIP, in particular when you have a massive margin. Right? What is the fair value of your stock and WIP? Is it the amount you paid it for, that it's held in the accounts at cost? Or is it the amount that you're going to sell it for after you've put a margin or markup on it? And the answer is it should be somewhere in between, right? But if it's the case that you put in, tens of thousands of pounds of improvement effort into all of your WIP, then the fair value is going to be a lot more than the cost it originally held. And depending on the size of your stock and WIP and your materiality, you might need to calculate an uplift there, essentially, to some number between its cost and its sales value. Right, what does all this do? Well, you do need to think this through again, and the message remains, think ahead, because actually all these new intangibles that went on your balance sheet will be amortized. Your goodwill is going to be amortized, besides which you've just literally got a bigger balance sheet, which is going to change some bank covenant metrics. Any uplifted fixed assets are now going to have higher depreciation, and any uplifted stock is now going to basically hit the P&L as cost of sales when you sell that stock. So all these things are going to hit your P&L and are going to reduce the profits made by your business, right? Think ahead for this, because it might impact covenants, it might impact earn-out payments, right? Actually, if you are acquiring a business, be aware that fair valuing that stock upwards is going to reduce your profits in the short term afterwards. I suppose that might be vaguely useful if you have to pay an amount to the people you bought it from. If you are selling a business, then you very much want them to properly uplift that stock value so that the EBITDA is calculated correctly, right? Fail to plan, plan to fail. Just think about the impact all these things will have before you finalize your earn-out agreements. And certainly before you finalize your accounting or deal with your bank covenants. Hopefully that was a useful little tour of acquisition accounting, what you have to do for bits of it, but also some of the, afterwards pitfalls that you need to negotiate for and think ahead about. Closing themes on all of this: compliance and forward thinking, right? Many rules are changing at the moment, including right now ID verification and failure to prevent fraud, right? Work ahead for those. And also the rules changing in the near future, in particular the IFRS 102 rules, right? Those might change your covenants, earnouts, bonuses. Plan ahead from that. Be ready. Hopefully this has been a useful presentation. If you've got any questions about any of the above, please get in touch with us. We would be happy to help. Best of luck.